Hey there, Kenneth French of Vast Voice, telling business secrets to entrepreneurs. We're very, very happy you stopped by. Either you're going to watch this or listen to this because you want to take your business to the next level. You're probably an entrepreneur who's either just starting out or you've been around for quite a while and you want to take your business to the next level. You're probably a real estate investor, maybe even a real estate agent, maybe a professional or of some sort, professional advisor of some sort. And well, you are stopping by because you need some valuable advice from one of the top industry leaders there is. Anyway, thank you very much. Once again, Kenneth French, Vast Voice, telling business secrets to entrepreneurs. Really glad you stopped by.
It's Kenneth French. We're going to talk money, ways to make big money with Bill Fairman. Bill, thanks for being here.
Oh, it's awesome being here. Thank you so much for asking me.
So as you know, all these people are, they're pretty well heeled. Most of them are business owners. Pretty much all of them are real estate investors. All of them are from really all over the country. We have a pretty good number of people from, the Southeast, and that's kind of your world. So let's get right to it. Give me one bit of advice for any person who, fits that description. Help them get rich right off the bat.
Getting rich is not right off the bat. That's my biggest advice.
Yeah, there you go. I like that.
Real estate as a whole it's a longer term process. Yes, you can hit some home runs, but you can hit just as many foul balls as well. It's a process. And in my opinion, being on the banking side is the steadiest, safest way to invest in real estate.
What's that? I like the sound of that. What do you mean? Is that why banks are always the biggest buildings in every city?
Yeah. All right. So when you own a piece of property, you're 100% at risk. When you're the lender, you're only risking somewhere between 50, 60, 70% of the value. So you're already on the defensive side of things. And at the same time, you don't have to worry about taxes, insurance, maintenance, tenants, toilets, trash. You don't have to worry about any of that stuff because the person that owns the building is the one that has to worry about all that.
Huh. All right. Try to convince me. All right. I like where you're going with that because, there's this infinite banking concept. There's all these concepts out there.
Sure.
Convince me. I'm going to be neutral because I like the way you think, by the way. But, do a little bit more convincing.
All right. So there's the upside to owning property is that you get appreciation over time. So you have a nice upside. You also get tax benefits that the government gives you, which is also an upside. On the banking side, you don't have any of the appreciation or the growth. But if the investment is set up in a way that you can compound your returns over time, you still get the growth. So I'll give you an example. Let's take a $300,000 loan at 11% interest only.
I like that. Yep.
Okay. So you're going to earn $32,700 and some odd dollars per year, every year on that $300,000. Okay. So let's say after 20 years, that 300,000 would turn into 900,000. That's not too shabby, right?
Okay.
You can take that same $300,000 at 8.5% compounded, and in 20 years you'll have 1.9 million.
I like that better.
Right. So there's your growth.
Okay.
You do it in a compounding, steady manner. Because with compounding, Einstein said that compounding was the eighth wonder of the world. He also said that those who understand interest receive it, and those who don't pay it. Smart guy.
Yeah.
But as far as assets go, you're much more diversified, in my opinion, being on the bank side, because you can take a lot more of your assets and spread them around. Meaning, if I'm only in it for 50%, I can take the other 50% that I would have and put it into an additional asset. And I'm still only at risk of 50% of the value. Right?
Yep. I'm vibing with you.
Scenario, they stop paying you. What are you going to do? You're going to sell it as quickly as possible so you can get your money back and get it reinvested.
You mean
Most
selling the
people-
asset that you've come to own because you're not getting money on it. So you sell that hopefully for a lot of money because it's undervalued anyway.
Well, your goal is not to make money when you sell these. Your goal is to get your money back quickly, because if you're trying to make money, you're going to try and get the best price for it, which means it's going to take longer to sell it,
Yeah, that's true.
which means your money is not invested. And in the long run, you end up losing because you've lost the opportunity.
Right, I understand your point,
But
but
it's
you get my on the
I
flip
understand
side.
what you're talking about. There
Yeah.
are people that lend money for the purpose of, if they don't really care about, let's say, the income and the credit and the character of the person you're lending it to. All they care about is getting the property. That's just part of the game they like to play.
Yep.
From my perspective, I'm lending not just on the property, I'm lending on the person as well, because I don't want it back.
You don't want it back. Yeah.
I want the return that I get. If I wanted it back, I would just get in the game and buy it myself.
Yeah, you don't want a loan to own in effect. Yeah, I get you.
Right.
Yep. All right.
A lot of people look at return on investment, ROI. I look at return on effort, ROE.
You want no effort, but lots of return.
Too much effort, I'm moving on to something else.
Yep, I get it. So, okay, before we get to, we're going to be hanging out for another, 25 minutes.
Sure.
How does someone get a hold of you, and why you, by the way? It sounds like you're a guru, but give us a little bit of background as to who you are so people can understand that, yeah, you're the guy we should be listening to about this.
So I've been in the mortgage business about 30 years. Started off in the retail mortgage industry, doing conventional loans in the residential space. Eventually got into the commercial side of things, on the wholesale side, which means I've looked at thousands and thousands of transactions because I had other mortgage people sending me business. So I'm always looking and underwriting those properties. During the 2008 crash,
The fun crash,
yeah, I, like many other people in my industry, found myself unemployed and unemployable.
Yeah.
My sister and I started this business. She also had a mortgage company, but around 2011, 10-ish, 11, there was a great opportunity to jump into the private lending space because you couldn't get loans, and we knew people that needed money, and we knew people that had money in their self-directed retirement accounts, and we just brokered the two together, and we built our business from there. And now we have two funds that people can invest in.
And tell me about those funds a little bit. So, because I'm assuming those are in line with your low effort, huge rate of return as a result. So, tell me about those funds, and then again, how does someone get a hold of you? And then we'll launch into.
Sure. So let me start off with how you can get a hold of me. My email address is bill@chmlending.net. You can also go to billfairman.com. You can get all my information there as well.
And how's that spelled, by the way?
F as in Frank, AIRMAN.
Okay.
And everyone knows how to spell Bill, I hope.
If not, then we got big issues. Yeah.
Where were we? Oh, the funds. So
the fund,
we have two funds. One, you have to be accredited to be in it. It is an equity fund, and all that means is you don't have equity in the buildings. You have equity in the company that makes loans. Okay. So you get paid distributions quarterly based on the profit that the lending company makes every quarter. You have the opportunity to take whatever the return is that quarter and have it ACH to your bank account, or you can take your distribution and roll it over and compound it over time. So it's the perfect vehicle for somebody that is looking for growth. We also have another opportunity for people that are not accredited. By the way, the first equity fund, the minimum is $50,000 investment. The other fund is the minimum is 25, and you do not have to be accredited. Now, this one is a debt fund. So what happens there is, as an investor, you are lending the fund money. So you have three different terms. You have a 12-month term, a 36-month term, or a 60-month term. So currently the rates are 7.5%, 8.5%, and 9.5%, depending on how long you keep it in there. And it's just a term. So at the end of 12 months, you get your money back, or you can do another term. So in the meantime, you're getting monthly payments based on that 7.5%, 8.5%, 9.5% term.
Got it. All right. Well, thank you for going over
Sure.
all that.
And all the money is being used to capitalize us so we can make loans to real estate investors.
Which are in line with some of the concepts we talked about at the outset. So let's get back into that.
Sure.
What are some other? So you're only investing in the Southeast, and you're
We
only
only lend in the Southeast. We take investors from everywhere.
Very good point. Very good point. In every state, then. Yeah. Okay. Yeah, that's important. I'm glad you made that distinction. So give me a little bit more of a flavor for, some of the investments. It sounds like pretty much, any commercial investment per se.
Well, if you're in the business, you know that you don't want to be investing in office space right now. We have completely changed the way we work. And depending on the type of office space, there's some real distress in the office space.
Well, hold on. Actually, let me stop you there. So what you're saying is because there's distress, it's not the right place to invest in. Now, let's play devil's advocate.
Sure.
Well, wait a minute. There's distress, which probably means numbers are down. Right? Costs are down, meaning prices are down. Isn't that the right time to invest in commercial space then as a result?
Well, it depends on the market where you are. If you're in the suburbs, office space it's not something you're going to run from. If you're in larger cities, in the business district, listen, anecdotally, we have, I'm in the Charlotte market, and we have 3 major, multi-story towers that are in receivership right now that only have 20-30% occupancy. What do you do with that space? Even if you can buy it at pennies on the dollar, what are you going to do with it? You still can't operate it with 20-30%. It's not cost effective to turn it into housing either. So what do you do with that stuff? Real estate is local, but for the most part, I told you about this earlier, I like the return on effort part. So we stick with recession resistant, multi-tenanted commercial properties such as self-storage, retail strip centers, light industrial. Now, there's a super big shortage of residential housing right now. This is why
that's crazy.
Prices of residential homes have not gone down, even though mortgage interest rates have gone sky high. There's a shortage, and there's a supply and demand issue. So we have the same problem with light industrial property. There's a shortage of it. So it's not a bad investment to be in. Self-storage, we have an unhealthy relationship with our stuff, and it's a great business model. You have, as you're working up the economic ladder, you buy new stuff. You don't want to get rid of your old stuff. On the way down the economic ladder, you downsize, but you don't want to get rid of your stuff, so you store it. Aunt Betty dies, and now you have an emotional attachment to the stuff, and you won't get rid of it. On the retail side, small strip centers are not affected by Amazon. So Amazon can't deliver you hot coffee. They can't do your hair, your nails, your taxes. Those are businesses that are local and are needed in the space. So those are decent businesses to be in. And then we're also in the single family, and we try to stay in the median price point. And I'm starting to rethink this a little bit, and I'll tell you why in a minute. But the median price point, whatever area that you're in, because you're typically going to have your empty nesters, your investors, and your first-time home buyers are going to be the ones that look for that. And from the banking side, you're always looking if they stop paying and you have to take it back, you want to get rid of it as quickly as possible. And at least in the median price point, you have a larger piece of the buying pie out there in the median price point. However, that said, because of our current economic situation, the homes that are $1 million plus is the only part of the residential housing market that actually is showing growth right now. So there could be opportunity there.
Wow. Yeah, no, I hear you. It sounds like you're an opportunistic lender or investor, really, and those are the ones that I think are making money right now.
Well, we are small. We're not institutional. Okay.
Mm-hmm.
The benefit to that is we can pivot quickly.
Mm-hmm.
And part of why I'm a big fan of mastermind groups is that we get to see the market real time all over the country. And we can change before it affects us.
Mm-hmm.
So we can be proactive rather than reactive to market changes. And because we are small and private and we raise our own capital, we control what we can lend on.
Now, there's a lot of benefits in that. People don't realize that. I mean, if you're smaller, you can be more nimble, and if you're smaller, you have a relationship with investors. They're not just a number to you.
Right. Yeah. Listen, my mom and dad are in our fund. So it wouldn't be a really great Thanksgiving if we had issues.
Yeah, if you lost a bunch of money, plus it's harder now. If you really think, here's a concept. I know you know this, but if you're investing, let's say you're lending for hard money. Let's just say, to be very simple, and rates are. I'm just making this up, 5%, but because it's hard money, you're getting 10%. You're giving 10%, or I should say, getting as an investor 10%. You're doing hard money. And the downside is, yeah, you get the property, but if you resell it, then you're still hopefully going to get more money down the road. But being a lender, I think in a lot of cases does make sense because you're getting, what your rate of return is because you have paperwork documentation saying what your rate of return is.
Sure.
And at the same time, yeah, you get the property, which is a bummer. But then again, if you turn it into cash quickly, you're making more money. And then all the way along the line, by the way, if the worst thing comes to worst, you're still getting, or best comes to best, you're still making money on the interest payments that if they're fulfilling the contract, you're good to go. And based on what you're saying, little effort. So that's a gross summary of your situation and you as an investor. Again, way gross example. I'm sure you wouldn't agree with that, but the concept is strong.
Well, in 2021, 2022, when the residential housing was just booming and taking off and appreciating at 20%, we were really boring because we were chugging along at between 8.5% and 10% annualized, and that's nothing. But it's the tortoise and the hare thing.
Well,
now on the equity side, your downside is really a downside. You're seeing a lot of funds that are strictly syndicated. And it could be multifamily, it could be commercial, doesn't matter. There's a lot of people struggling right now because it takes a long time for projects to come to fruition. And if you did your original prospectus based on numbers, 3 years ago, you're probably going to have some issues because they're not penciling out like they would have earlier. Now, on the lending side, that doesn't really hurt you much unless you had too much of that property inside of your portfolio that you're lending on. Fortunately for us, our commercial stuff is $3 million or less in value. So even if you lose a couple of them, it's not hurting you much.
Yeah. Well, hopefully. Yeah, because you have diversification.
Sure.
Which I see there being a fit here between us because at vastsolutionsgroup.com we just started a while back. We started a commercial property lending unit, and it's we do deals. Our minimum, really, if you really think about it, it's $5 million above, and we do we're working on a $200 million deal right now. I mean, we work on bigger deals, and what's nice is I think what you said. The less work, the better for the investor. If someone comes in and lends, let's say, $100 million on one of our properties, that sounds really cool, by the way, saying $100 million. And they're not expending a bunch of time, but they're making a good rate of return. It really does work out. It really works out for the client. I mean, the end user is taken care of because the borrower's gotten some huge building. The investor is happy because they're getting a rate of return. Yes, it would be bad if they the borrower doesn't come through. But then again, at least, as you said, they're going to hopefully get rid of the asset, turn the money into, cash flow, et cetera. It works out. But anyway, I digress. I just wanted to say that we loan $200 million, so we sound really cool.
Sweet.
Anyway, so let me ask a couple more questions. Why only the Southeast? Why aren't you investing in whatever the Northeast as an example?
Well, one of our niches is that we look at each deal individually as a whole and all of its parts. So it's the borrower, it's the property, it's the location of the property, it's the project that you're trying to accomplish.
Mm-hmm.
And we can lend a little bit more utilizing that global underwrite because we understand our market,
Mm-hmm.
because we're sticking with it. And if we had to expand out further, I don't have boots on the ground out in different parts of the country. I would have to start lending inside the box like the institutional people do because of the same thing. It's protecting yourself. And I would rather be able to step out there a little bit more and help our clients. That gives us, kind of a leg up on the institutional folks.
Got it.
And for me, it's easier to go deeper in our market than it is for me to expand, because there's another thing about expanding nationally is that once you create a particular size, then you have to continually feed it. And
that's the problem. Yeah, exactly.
Yeah.
That's the problem with the institutions, right? Like
Yeah.
if someone gives them whatever, I don't know, whatever, $100 million as an example, they're expected to, even if it's a good or bad deal, to deploy that capital, and it might be a bad deal, but they have to deploy that capital.
Right. You're not going to see institutional investors tell their investors, "No, I don't need this much money here. I'm giving it back to you."
Exactly.
That never happens. They have to spend it.
Yeah.
Or they have to try to put it to work. And what ends up happening is they either get into deals that they shouldn't, or they're investing it in stuff that's not very high yield.
Yep. And then the investor ends up being bad, but they make their money. The big investor,
sure they do.
Yeah, I know, I get it. And not to put down big companies. I shouldn't do that, but I get your point. So wait a minute. So how many of the equity fund? How many deals are you doing on an annual basis? Let's say.
Well, I can tell you right now, we have about 170 some odd deals in our fund right now.
On the equity side. And then what about the debt side?
They both work hand in hand. What I
do?
end up doing, I originate everything in the equity fund, and then on the debt fund, I will assign loans over to the debt fund.
Oh, I got you. So they might be. Oh, I got it. So they might be doing the same project.
Everything is originated in the same equity fund, and then we will assign notes over to the other one. So what I'm doing is I'm providing folks that weren't accredited or people that are strictly want to have a set income each month. I'm giving them an opportunity to get in.
I understand.
Because your return is going to fluctuate a little bit inside the equity fund because it's based on the profit. And some people want a guaranteed, rate of return.
Yep. And have you ever missed a payment?
No.
Yep. I wouldn't think so. Just to throw that out. By the way, what I should say is, talk to your advisor, talk to Bill Fairman, if it makes sense. This isn't, we're not providing any guidance here. We're just, this is entertainment. You get to hang out with Bill and Kenner there for a while. You like that?
Yes.
Well, what else? What's something we haven't talked about that would, add value to a listener or a viewer, so they can think, well, maybe I should be doing some type, acting as a bank versus, me being a proactive investor, et cetera, et cetera.
If you have self-directed retirement funds, they love the lending side. The IRS loves the lending side. When you start getting involved in real estate, first of all, you're giving up the tax benefits that the government already gives you when you buy an asset in your retirement account. When you're investing in something that doesn't give you any tax benefits, at least you're being more efficient with your taxes. Okay. Mm-hmm. I just love the lending side because I believe it's safer than owning property. Now, I always tell people they still should own property. Just don't do it in your self-directed retirement account. Be a lender in your self-directed retirement account. Listen, I own property. I own self-storage. I own retail strip centers. I own short-term rentals, but I don't have any of that in my retirement account.
Yeah, let's hold on. Let's back up. Thank you. That's really good, Bill. So let's talk about that. So I think the vast majority of our people do know what self-directed investments are, but let's go over it real quickly. So a lot of people, to the listeners and viewers out there, what Bill's talking about is in let's say a IRA or a Roth IRA, maybe even a 401k, profit sharing plan, maybe even a defined benefit plan. People don't realize that you can, generally speaking, within certain bounds, you can invest in real estate. So yes, you can invest in, as an example, apartment buildings. You can invest in, as an example, a duplex, as an example, right? So you might hear out there, no, you can't invest in that stuff. You have to invest in stock market, stocks, bonds, mutual funds. That is not the case. You can also invest in cool stuff like Bill's, Reg D fund, as an example, et cetera, et cetera. Now, it's kind of cool. It gives you diversification if you're highly invested in stock market, as an example, or highly invested in mutual funds, which is the stock market to a certain extent. So people have got to realize that, yes, you can invest in things that are outside the normal investments, that being real estate. So anyway, so what you're saying, now continue on, because I think that you bring up a really good point, Bill, as to some of the things you should and shouldn't invest your, let's say, IRA assets in when it comes to real estate.
Let me start by saying that there's only like 10% of the population that even knows you can self-direct your retirement account. And you can go to your Schwab or any of your other managers, Vanguard, and say, I'd like to self-direct my retirement account. And they say, sure, here's this basket of stocks that you can choose from.
Yeah.
Well, that's not self-directing.
There you go.
You're just self-directing stuff that they're allowing you to self-direct. It's still the stock market.
There you go. Yeah.
Listen, there's nothing wrong with the stock market, but I feel that most people that are investing are typically homeowners, and they understand real estate more than they understand the stock market, right? And wouldn't it be nice to be able to invest in stuff you already know about? It doesn't mean that you're doing the investing. You can still have somebody else do it, but at least if you understand the market, you feel better about what you're investing in. I kind of feel like the stock market is rigged, and it's the people that are the institutional folks that are making all the money. It's us lemmings that end up, getting in too late, getting out too late, and end up not making anything. A 401k is a good savings plan. It's not going to get you wealthy. Okay. Now, there's a few things that you can do in real estate with your IRA that's kind of interesting. You can actually buy a rental property. Let's say you wanted to move to Florida when you retire, and you find that a house in a neighborhood that you would like to eventually retire to. Now, if you buy this inside of your IRA and use it as a rental property, you can't stay there. You can't fix it. You can't even change a light bulb in it. You have to have a management company to do it. But one of the things you can do is you can buy it in your IRA. If it's in a Roth, or even if it's in a traditional, you can always convert that traditional to a Roth at some point. Now, imagine this. At the end of when you're ready to retire, and now you can cash out of your IRA, you fix this property up after it's been rented for years and years. You cash it out in your IRA, and then you can move into it, and it's completely paid for in your retirement account.
Yeah.
That's a great way to do it. There's a lot of ways that you can invest in funds, and this is next level stuff, so I'll just be brief on it.
Go for it.
But you can invest in a private placement fund in a traditional IRA, and then convert it to a Roth IRA. Now, when you convert a traditional to a Roth, you have to pay taxes on the traditional, on the money you're converting, because a Roth is pre-taxed money, and a traditional is deferred. So you would have to take it, the taxes, as you start receiving it, right? So let's say you invest in a fund that's a private placement and you have to stay in the fund for at least 2 years before you can take any money out. Do you think that investment in that fund is still worth the same amount of money you put in it to somebody else? So if I can't sell my shares readily because there's a 2-year hold period, and the manager of the fund says you can't sell it to somebody that I won't approve you getting into the fund because they may not even be accredited, right? So there's companies out there that will appraise that investment, and then you turn that in. You pay tax on the appraised value. So for a quick example, you put in $100,000, it may only be worth $60,000 to the general public. So now you're only paying taxes on the $60,000. So there's a lot of stuff you can do with IRAs and be very tax efficient. I mean, you can even do that with some of your defined benefit plans as well.
Right.
I love this stuff. I geek out on this stuff.
And that's why we're in business, because a lot of people don't know this stuff. I mean, nobody knows this stuff. It's so important because it adds to, one's net worth. And we believe, I mean, at the end of the day, we're a tax company that, does finance, if you really think about it.
Right.
And if we can, strategies like this, if we could lower taxes, if we could help strategize for business owners, they'll be that much better off, and hopefully happier in retirement as a result. So I think the stuff that you're talking about is totally on par.
Yeah, it's not just about how much you make; it's about how much you get to keep.
Yeah,
right?
Exactly.
In my opinion, the retirement business is broken. At least the way they teach it.
The way
they teach you the accumulation model, and then once you accumulate a certain amount of money, then you can retire, and then you'll start living off of it, and then hopefully that you'll die before you run out of money. It shouldn't be that way. It should be that you continue to earn. You continue to, even when you pass away, should continue to earn. So you have a legacy that you can pass on. It could be to your kids. It could be to community. It doesn't matter. It shouldn't be that you just save enough money and then hopefully that you die before you run out.
You're exactly right. I mean, which is shocking to me, because you're right. It's a broken industry. I mean, by the way, no one, if you really think about it, no one really is taught the income portion. Everyone's taught the accumulation portion, but the income portion is the most important element, because you don't want to run out of money in retirement, right? Well, one way to combat that is knowing how to strategize the income component. And a lot of people, if you really think about it, what really people should do is, let's say, they work for whatever, 30 years, and then right as they retire, they just start taking income out. Really, a few years before then, that's when at a minimum they should really start figuring out their situation so they can take out the income on a tax efficient basis, and so they don't run out of money. That's really when it should start. And some people would even say it should start earlier than that, and I probably would agree with that. But anyway, I love that you and I totally agree on this. So give me here, we're just about to land this plane. I really appreciate you taking the time to talk about all this stuff, Bill, because it's fascinating, the stuff we've talked about. What's one thing that we have not discussed that you think the listeners and viewers should learn and hear about before we sign off?
Well, one more assumption too is that when you're in retirement, that you're going to spend a lot less money. Why should you alter your lifestyle just because you've retired?
That's true too.
You shouldn't. And being invested in something that is going to pay you an income where you're living off the money and you're not touching the principal, that should be your goal. And it doesn't really matter if you're in real estate, or if you're in the stock market, or if you buy businesses to do the same thing. Your passive income could just be from other businesses that you've bought and flipped. There's all kinds of ways of doing it. I prefer real estate because I'm in this industry and I know it well, but there's plenty of people that are really good at finding small businesses, scaling them up and selling them, and then living off of the passive income from that. I just say, whatever you do, don't do the accumulation model. And then whatever you do as well, make sure you do it as tax efficient as possible.
Yep. I like it. Holy mackerel, Bill. I think, we've only been able to hang out for like 35 minutes, but I'd say we have you on down the road and we get a little bit more in depth and really, really, kind of, pull the skin off the onion and really kind of go a little bit deeper even. I'd love to, because you and I, obviously, we agree on a lot of stuff.
Awesome. Love to.
All right, cool. Well, guys, once again, you know how to get a hold of Bill. This is Kenneth French signing off, Vast Voice, telling business secrets to entrepreneurs. Hopefully we've added value. If you have any questions, have any input, please go ahead and email us, info@vastsolutionsgroup.com, info@vastsolutionsgroup.com. We'd love to hear whatever input you have, however we can make the show more and more fun. Thanks, everybody.